Hello, my name is Bruce Boldrin. I'm founder of the Enterprise Engagement Alliance. We're an outreach and education organization dedicated to promoting a more effective form of capitalism, one that focuses on enhancing returns for investors by creating value for customers, employees, supply chain and distribution partners, communities, and the environment. And these sessions are really designed to be not just thought-provoking, but actually training programs in effect. And we put all of these programs into a library that people can easily access to take advantage of all the ways to improve your life and business by focusing on value creation. So today we're pleased to have Jason Britton, managing partner for Reflection Companies. He's going to tell us what he does, but obviously it's related to impact investing. And Brian Potts, he's co-founder of Goods Unitas and also an attorney. And he too will tell us a little bit more about what he does. He's been on one of our shows before. And before we get into the meat of this subject on impact investing, is it an alpha or is it a trade-off? I just, of course, want to remind everybody of the customers that we help do business in this new world of stakeholder management and thank them for their support of us. And to remind everybody that we are practicing stakeholder capitalists. We give away a whole bunch of information. You don't have to pay one penny to learn how to implement this really what is simply total quality management for people into any size organization. So I'm going to stop that share now, gentlemen, and thank you both for coming. And Jason, I'm going to get right into it with you. But first, I did want to have you tell us quickly what you do and about your company.
Sure. Well, it's very nice to be here.
Thank
My name
you.
is Jason Britton, and I'm the President and Chief Investment Officer of Reflection Asset Management, which is an SEC-registered investment advisor. We specialize in building product, Bruce, that aligns with exactly the concepts you were talking about, finding and rewarding those companies, and also, in turn, the investors by creating investment product that looks at stakeholder engagement and what that means with a capital S. I'm also the president and managing partner of a company called Reflect. Reflection Analytics and Reflect are a tool designed to allow financial advisors to essentially diagnose their own portfolios for alignment with those values and principles that drive their lives and that they in turn want to see in their investments.
Well, this is exactly why we invited you to be on the show. So my first question to you, and I'm going to get to you the same question, Brian. There are a number of states in this country that are actually passing laws that forbid public funds from investing companies based on what you just outlined. I'm going to get right to the point. Is this almost depriving the public the ability to benefit from a potential alpha?
So, full disclosure, I'm actually on the ban list in the state of Texas. My firm, Reflection Asset Management, we have received from Gene Hager a lovely "I love you" letter saying we are no longer welcome to do business with any of the public institutions in Texas, to which I say thank you very much. Because they are in fact costing somewhere between $300 and $500 million a year in incremental interest simply on their municipal bond portfolio by not being able to do business with companies that are on that blackballed list. There was a letter and an article that came out of the Wharton School. Now, nobody's going to accuse the Wharton School of being hard left-leaning around what the actual costs were to the pensioners, citizens, and teachers of the state of Texas, and it's no longer up for debate. It is a large number that this sort of blinded arrogance and ignorance, frankly, costs.
Well, I started with something a little controversial, and I'm going to ask you, Brian, to comment on it also because you're an attorney. But please first start with telling us what you do.
Yeah, thanks, Bruce. I'm co-founder of a company called Goods Unitas, and we are a data company exposing what corporations are doing in politics, in U.S. politics, and in particular, mapping the exact effects that corporations have on political outcomes, including down to the issue level. So I'm a co-founder of that company. I know Jason pretty well because Goods Unitas has licensed its data to one of the products that Jason has created, which is a ETF. It's called DEMS, DEMZ. It's the Democratic Large Cap Core ETF. And I'm a lawyer, not a financial guy, but I like to think of Dems as the S&P without the GOP. And we can come back to that in a minute. To answer your question, as a co-founder of a data company, I believe strongly in transparency. And so the idea that you would ban any fund from using publicly available data to make decisions, investment decisions about companies seems silly to me, and frankly anti-American. If data is available about companies, investors should be able to rely on that data when making decisions about those companies and whether to invest in those companies. Jason has a lot more of the detail of the specific ramifications of these kinds of decisions in the finance world. But as a lawyer and somebody who understands how our country is governed and the Constitution, the idea that anyone would ban anyone from relying on data when making investment decisions seems silly and short-sighted.
Well, thank you. So let's get into this whole issue of, I've been following for more years, and I want to admit this whole debate related to, if we're focusing on people, are we hurting the shareholders? Are we somehow diverting profits that should be going into stock buybacks, dividends for shareholders if we invest in our people? And by the way, Jason, when I talk about people, I don't just mean employees. I mean customers. I mean our supply chain and distribution partners there, and our communities that in many ways endure us as a big business. What evidence is there that there truly is an alpha to investing in people? We always say people are number one assets, but it doesn't seem to be the way most companies are managed. But what do you see in terms of the data?
So, Bruce, that's an excellent point. And just to put sort of a round out on the last comment and question, because it dovetails nicely here, when I say that it is ludicrous that the state legislature in Texas has prohibited this kind of investing, that's not to say that left-leaning is better than right-leaning, et cetera. We're talking about values-based investing, and that values, as you just pointed out, can be human capital-centric. And when you talk about the stakeholder, you talk about all those different groups that you mentioned. And you made a very fine point, because whether an investor wants to see their politics, their faith, or any other number of things expressed in their portfolio, that values-based investing, I think, should be protected, right? Because it's their lens. As it relates to the question you specifically asked around human capital, you needn't look any further than the point that you made around how do we think about assets versus liabilities. And every CEO in CEO school gets taught that sentence, right? My people are my number one priority. Our customer is number one. But if you look at financial statements and how GAAP accounting works, people are nowhere carried on the balance sheet, right? They're generally treated as selling and general administrative expenses, and treated as a liability on the income statement. And that is all you really need to know in how they think and value the labor inputs, the community, so on and so forth. A company that thinks about managing its human capital thoughtfully can reduce turnover, can improve customer education and experience, can have a brand halo where people will actually stand in line and pay more for that product because of what they perceive to be that particular corporation's, overall benefit to society, the community in which they live, or their own personal lives. That's what we're talking about quantifying here, is not just the company that pays its employees most. That's not necessarily what we're talking about, although there is a living wage sort of understanding and mandate. But the broader picture of investing in those big S stakeholder issues, that can't be overstated, in my opinion.
Well, Brian, and this gets to the point of transparency that you raised. How do we know these things? Because it's not on the balance sheet, right? When customers are pissed off because of bad customer service, there's no way to know that. And I think I sent both of you an article from a professor, I believe at Harvard, called Dark Accounting. And she makes in great detail the point that Jason is, that none of this appears on the balance sheet. So from your standpoint, how did people even get to this information? How do we find out? And I'm going to get back to you with that as well, Jason, on how do we find out whether there are risks and opportunities given to how companies are treating their stakeholders?
Well, I mean, and I'd put the converse, really. If if ESG is banned and you can't consider any ESG data, first of all, what does that even mean? What is classified in the ESG category that is banned? And second, if you're prohibiting people from learning data about employees or whether it be their gender or their diversity or anything else, that's data that could and does commonly inform investment decisions. So, one example that I can use, because it's data from our company, we have the politics and we know the politics of the C-suite of companies. And we hypothesized before we even got into this world a few years ago that the politics of the C-suite would be tied to ESG scores. And we did an analysis and found that statistically it was tied to higher ESG scores. Similarly, and maybe not as apparent, we did an analysis back in 2020 looking at the Democrats in the C-suite versus Republicans in the C-suite, and we found that Democratic companies in the S&P 500, meaning those with Democrats in the C-suite and that had given more to Democrats, outperformed the Republican companies and the market, both on an equal weight and a market cap based analysis going back 5 years from 2020. So it wasn't just tech and healthcare, because we did it equal weight. Now, am I saying for sure the Democratic, C-suite is always going to outperform? No, but is that data that investors should be able to look at and consider? I absolutely think they should.
And I want to stress to the viewers that the Enterprise Engagement Alliance is completely nonpartisan. We welcome everybody of every type into this organization because it's simply better business. So getting back to you, Jason, on this whole issue of alpha, it seems to me, and transparency, tell us a little bit about what your experience is in terms of identifying the alpha or risks, how it has affected your investment portfolio, and a third related question, where do you get the data?
All great questions. So we actually have a patent on a process we refer to as SEE, S-E-E, like vision, C. It stands for Stakeholder, Environment, and Ethos and Ethics. And we attempt to quantify a corporation on roughly 75 unique data points on how thoughtful they are around governance, stakeholder engagement, living wages, diversity, equity, and inclusion, their environmental footprint and management, inputs, throughputs, and outputs, and efficiency, supply chain engagement. And then on that ethos and ethics side, we try to describe, are these corporations active and productive members of society, or are they literally just trying to squeeze every last dollar of profitability out of the organization? And to be clear on the politics side too, I'm not advocating one way or the other for either Democrat or Republican, because we've been tracking a GOP version of the Dems, so the sister company, if you will, the alternate ego personality. And it's doing quite well too in the right market environments when constructed thoughtfully, and that's the key.
We'll talk about that later. We're going to get to that.
When you said on that alpha piece, right? I absolutely believe that you can use ESG data, if you want to call it that, C data, if you want to call it that, and whittle an investable universe down to an approachable group of, say, 100 or so companies, if you're thinking about the S&P. And then putting those pieces together thoughtfully around where we are in the business cycle, where we are in the interest rate cycle, that's where the additional magic is. So I would always answer that question that no, doing ESG, SRI, impact, whatever you want to call it, doesn't mean you have to outperform. It just means it helps you find the nuggets of a quality portfolio. You still have to put those pieces together, though, in a thoughtful way to make it work.
In other words, it is just one factor in the success of an organization. That you might have the wrong product, you could have the best meaning, or your market could have completely changed, or you could have misjudged the market, or your major customer could have gone bankrupt right when you didn't have any cash. I mean, there's so many things, and I think it's really important for all of us to realize that um, stakeholder capitalism is not going to protect you from failure. It's simply building yourself on a better foundation. So getting a little bit more into this source of information, Jason, where are you getting this information? Because it's tough to get.
It's incredibly difficult to get. And when you can get it, oftentimes it's bad and expensive. We're sourcing most of our data from company self-reported materials, having created various scraping mechanisms and various other technical things that I'm not going to embarrass myself by trying to explain because that's not my world. But we're essentially going out to data aggregators, places like Bloomberg and Morningstar, and bringing that data into a format that we believe to be useful, where we have tried and tested those 75 or so points that we look at. I mean, if you think about the data, the sheer volume of data that's out there, and then also for your viewers, when you look at historically ESG data as it's currently produced by the big three, if you will, MSCI, Sustainalytics, and Refinitiv or Reuters, those were all crafted as business decision tools 25 years ago that were supposed to be for managements to be able to make internal decisions on where ESG risks lie in their business model. So it was about them protecting profitability and being exposed to ESG risks. They were never conceived to be tools for investors to sift between companies or to make decisions. It's just been used wrong for 25 years, and the industry knows it, but they're not really doing anything about it. We decided to change it and say, okay, ignore all of that has been done, go out and get hard factual data, scrub it, test it, see if it makes sense. And one of the points, as Brian mentioned, why we were drawn to the political data is because there's a strong correlation with that, political giving, civic engagement, and that's on both sides, right? The companies that are deeply committed to one way or the other and advocating for that tend to be opposite in their political views, but they tend to be implementing things that still work for stakeholders. Well, they're coming at it from a different. This might be human capital and diversity. This might be people and creation care on the faith side. Those are not dissimilar things. They end up in the same place, which is valuing people and human capital.
Yeah.
It's the ones in the middle, the 5149s, that you sort of go, oh, maybe those are the folks we got to stay away from.
What's really interesting there is like Chick-fil-A, for instance, I think I don't know where they give money, but I believe that they're a conservative company. They're a terrific company relative to other companies in their marketplace. So again, this just has nothing to do with who you vote for. So, but let's get into this a little bit because it is interesting, and I think this is a really important point for investors, and we'll delve into it. The Dems, you guys developed an ETF for Dems, okay, that tracks companies that give a bunch of money to the Democrats, and they're outperforming the market. You've also created a mock ETF that I believe you hope to make a real ETF, a marketable ETF in the coming year, that is tracking companies that tend to give money to the GOP. And that too, is my understanding, is outperforming the market. So Jason, doesn't this kind of reinforce the point that you made that, again, it's not who you are voting for in a necessary, but what is it that these companies, you've kind of said it, but I think it's such an important point to make. What do these companies have in common that both of them can generate an alpha by focusing on the right stakeholders?
So I need to segment that question into two different pieces, because there's how they're thinking about what I'll call human capital inputs, so their workforce, right? And then what I'll refer to as the externalities of their impact on human capital, supply chain, stakeholders, et cetera. And when you really are looking at it from both a left and a right perspective, if you're going to, well, I don't want to call it the fringes, because that's not what I mean. What I mean to say is those who are deeply committed to those principles and are supporting those principles by their political spending, which is what the data from Goods Unite Us tells us, they're arriving in a similar place. Pay a living wage, right? Think about your people as important inputs, and you might use the language over here of they're part of the broader family, right? Like a Chick-fil-A might, right? We want opportunities for advancement. We want to support our communities. we want to be engaged in the way that we care about the world, you would see very similar language on the other side. They're just approaching it from a different perspective. The truth of the matter is, both of those things will give you a list of companies that have what I would consider to be high character management. And then now it's your responsibility as a portfolio manager to sift through those companies, because as you said, Bruce, I don't necessarily always want to own growth companies, or I don't necessarily want to always own defensives, right? It really depends on the marketplace in which we are in, where both of those portfolios, when well constructed, can outperform their peers. Because what you're really doing is I believe you're separating those managements that think about people and care about them, regardless of the language and how they get there, and those that don't.
Yeah,
So,
and I think, yeah, I could add something to that, which is just putting my lawyer lens on. It sounds like what you're saying, Jason, is the companies that have strong values, whatever those values are, tend to outperform. And that tends to trickle down through the workplace.
Workers know what the company culture is. They buy in, they support it, they're wholly invested. Customers know the company culture, its values, and whether it speaks to them or not, and they're invested. It's all about associating and doing business and spending capital in places that you identify. And those organizations that carve out a place and say, this is important to us, and whatever the important is in their language, right, translates into there is a group of people, as we all know, and we're 51-49, 49-51, depending on which year the election is. We're split right down the middle. What was 2020 is decided by 40,000 votes out of 300 million people and 190 something million registered voters. Like, we all care about things a great deal, right? Very passionate about it. And we do business, and there's plenty of room in a $19 trillion economy for people to look at the world in different ways, and both of those kinds of companies to be successful. It's not a zero-sum game otherwise.
Well, what's interesting then, readers and viewers, you can invest in if you have the right portfolio manager, you can invest in your own values and still potentially benefit from that alpha, which is kind of an interesting thing, because again, values are not just left wing or right wing. Values are people have values across the board. But Jason, I've been tracking this for years, and it does seem to me there's strong evidence that the alpha for companies that really focus, not greenwashing, they build it into who they are. And I mentioned a company like Wegmans, they're a private company, but Publix, I believe, is a public company. And these are companies that really have strong values. Costco, great example, Costco. The evidence to me from the different funds I've seen, we did our own mock ETF for 6 years between 2012 and 2018 that outperformed the S&P 500 by 38%. That's pretty significant. Everything I've seen, there's an alpha potential of around 2 to 3% a year, reasonably, if you're disciplined. Is that a fair? I mean, no one can ever guarantee anything, but what would you, if you had to estimate, if you're really managing your company well, you've got your customers passionate, your employees understand what the customer wants, your supply chain's on board, they're there with you when things get tough, right? Your distribution partners are putting you first, the communities welcome you when you come. What kind of alpha can that potentially get a company?
So it's hard to ascribe it down to the alpha level of the individual company, but a collection of those companies together in a portfolio. I don't have to guess, I can tell you exactly. We launched DEMS on November 2nd, 2020. And through the close on Friday, which would have been the end of the month of August, we're outperforming by 670 basis points, or 6.7%, which works out to be, good for you, Bruce, right around 2.25% a year annualized. So I think you can eke out between 2 and 3% after fees consistently if you're a disciplined portfolio manager and you can't make a great donut, pizza, car if you don't have good quality inputs. And these kinds of pieces of data helping you pick what companies you want to think about owning and then getting the recipe right, I think there can be alpha there.
Now, Brian, isn't that significant? 2 to 3 percentage points a year to a pension fund, let alone to me. and my family, because otherwise I would just do what Warren Buffett says, just buy the S&P 500 ETF, right? So if you want to get an alpha that of 2 or 3, is that significant?
Yeah, well, of course it's significant. And, I think really the reason we're even having this discussion and the reason that, you see a lot of these states banning ESG, which it's an overreaction to the problem that Jason already identified, which is a lot of the ESG data has been used incorrectly or isn't very accurate. And now, does that mean all of it's garbage? No, it's not what that means. It means you need to be careful about what your inputs are and what data you're relying on and how verifiable is it, which is why really we started using this political contribution data, because there's no subjectivity. It is data. It is 100% data about what the C-suite is doing and the company is doing with its money and how that impacts actual lawmaking in the United States. But that's just one example. There's lots of other data points out there that are verifiable, that are useful for either alpha determinations or value-based determinations, or both.
So both of you may be aware of a new law in Europe, the European Union Corporate Sustainability Reporting Directive, and it was designed to get rid of the real problem, which was greenwashing, because that's really what you're pointing to. A lot of this data, frankly, is greenwashing, or it's unverifiable, or it's used for marketing purposes to deceive people. And the Europeans said, okay, and they actually call it the anti-greenwashing law. And it requires at least 82 metrics that you actually have to put into a database that, by the way, Jason, I don't know whether you've looked at the amount of data, but it gets right down to what are the opportunities you create for the world? What are the risks that you create, right? And then what are you doing to maximize the opportunities? What are you doing to mitigate the risks? They call this double materiality. And then they want you to show data, and they want that data to be comparable, and you have the right to use different sources of data. But if you change the data, you have to report it. Jason, is this going to be good for investors, or is it just going to be an aggravation for corporations, or both?
So I think in the near term, it's probably going to be a little bit of both, because corporations are going to bellyache about having to collect and disseminate and right size that information. So CSRD and to a lesser extent SFRD, right, the Sustainable Finance Disclosure Requirements, I believe are just standard setting, right? I think it's the exact same thing. So prior to 1970, don't quote me exactly, but I want to say 72, there was no such thing as standardized accounting in the United States, right? We didn't have the GAAP principles, and now we do. But here's a little secret to our readers / viewers. GAAP accounting is probably the most widely abused and mistreated set of metrics on the face of the earth. So just because there's a standard doesn't mean people won't figure out how to try to report things in the absolute best light. But back to your point, though, I do think more information is powerful. I think standardized, accessible information is powerful. And to the point again around, it doesn't really matter if you're talking left, right, as long as it's commitment. We built for clients a biblical SMA, a separately managed account that was designed to take the S&P and run it through a series of biblical principles. You would not be shocked to find that the biblical principles are not that far off from a lot of the other things we're talking about. Care about people, care about the planet, right? Don't make products that kill people on purpose. Those kinds of things tend to be one and the same, regardless of the spectrum you're on. And we're outperforming right now by significant amounts, like close to those 20-something percentage points you were talking about over a 3-year basis. So it can
you're
be
saying
done.
biblical principles.
In this particular instance, yes, it's a biblical principle. We created it for an organization that was very deeply concerned about articles of their faith. But those things they're not the antithesis of one another. Caring about people, whether that's labor unions and affordable housing and so on and so forth, or that's for the poor and the least among us, being charitable, tithing, like you get to the same place, which is putting money back into communities.
It's very funny because we are also a non-religious, non-denominational organization. Yet when people ask me to understand stakeholder capitalism, it's just the practice of the golden rule in business. That's all. What executive would want to work for a company that underpays her, that treats her terribly, that lies to her. It's just the golden rule. So just coming to wrapping up here, Brian, the evidence, or one quick question. I don't know whether any of your clients, 3,000 US companies are going to be affected directly by CSRD. And, to them, I guarantee you, it's just going to be a compliance thing. First off, they're just going to think compliance, when really it's a business opportunity. If you think about it, it's like total quality management. In fact, I think of stakeholder capitalism as total quality management for stakeholders, a strategic and systematic approach based on your purpose, goals, objectives, and values, right? So have you heard of any companies, moaning and groaning about this, or is that outside of your field of practice?
Well, I'm an environmental lawyer. I've attended a lot of seminars where companies have complained about the European rules and panelists. But personally, my clients, I haven't heard much from them about them. But I think, anytime there's a new regulatory change, there's always some companies who are going to be winners. There's always some companies who are going to be losers, and it's always going to be some amount of work to implement. And so the question is really, I always sort of think with regulation, the proof is in the pudding. We'll know in 5 years or 10 years how effective those laws have been, both at their goals, and honestly, there's always business opportunities with regulations, like you said, and I'm sure there are going to be winners and losers, and some of the winners might be surprising.
Well, by the way,
Well, if I could,
go ahead, please, Jason.
well, I was just going to say I could add to that too. That so the European model is quite literally 24 months ahead of us, because just last September of 2023, the SEC expanded the definition of Rule 35D1 for the names rule to include ESG criteria. So historically, if you were a large cap US equity manager, you had to certify to the SEC that 80% of your holdings on a dollar weighted basis were in those large cap things, the thing you called yourself. It's called common sense retail marketing. If you call yourself the ESG Sustainable Select Fund and you own 10 integrated oil companies and weapons manufacturers, tobacco, pornography, and gambling, that's not going to pass the smell test with the retail customer, and you're going to be in violation of that rule. That rule takes effect. You must be compliant with 35D1, September 23 of 2025. You've got one more year from the end of this September to bring, if you have $1 billion in your ETF or mutual fund, to start submitting that report to the SEC. So they might bellyache about it, but they're going to get on the bus because the bus is leaving the station.
Well, guess what? I happen to agree with all of the greenwashing that we have seen since 2019 is despicable, and the corporate communications departments of this country set back stakeholder capitalism several years by simply lunging onto something they didn't understand, conflating it with corporate social responsibility, and it completely muddled the whole thing, when the argument is simply it's better business to treat people as an asset rather than as a resource that you extract from. You can get more money in the short term doing that, for sure. But how are you going to be 3 years later? Well, that CEO is usually gone by then, right? So anyway, wrapping up, this makes so much sense, Brian and Jason. I'm going to ask you guys two questions, both the same question to wrap up. There's so much evidence that a strategically and systematic approach to purpose, goals, objectives, and values in people is going to give you an alpha. And yet I would have to say, the United States, on average, I'd give us a score of about 3 out of 10 on average of how well organizations are managing to that principle. And that it is still, no, stakeholder capitalism is not a get rich quick scheme. Am I wrong about that low score? And do you see any hope of a change? Brian, and then you, Jason, to wrap up.
I can go first. I mean, as a lawyer for 20 years, I'm always a little cynical. It's just natural, it comes with the job. And so I think 3 is probably right, maybe 4, but with the caveat that, at least in my 20-year experience, every time new things come about, the adoption rate is slow and there will be a tipping point. And so it's not surprising to me that we're at a 3 or 4 right now. I think 10 years from now, I would expect us to be at a 5 or 6. And then at some point, it'll be a tipping point and we'll be, it'll be more normal, and we'll be debating some other thing that's at 3.
And Jason, you.
So I would agree with you. I think we're probably definitely towards the bottom half of that scale of 1 to 10. 3, 4 sounds about right to me. But I think that is self-inflicted. I think it's a self-inflicted wound because we won't embrace the language and the conversation around things that make that good common business sense that you talked about, right? We want to couch everything as in, well, if I pay more than the living wage in my particular industry, I'm overpaying for this, and I'm changing the margins for my my end user, my stakeholder, my shareholder. And what they really need to do is just pick up a textbook and read the theory of shared value, right? So it's Michael Porter from the Harvard Business School, right? The Institute for Strategy and Competitiveness. Neither Harvard nor Michael Porter necessarily known for being particularly religious or particularly left. And it's black and white, right? Societies need corporations to pay taxes and to create markets. Corporations need a functioning society to create law-abiding citizens, taxpayers, and consumers of goods. And as long as you don't get too far out of whack on one of those two things, the pie can get bigger and everybody can do better. And that's what I think we have to do, is we have to stop looking, when you think about, and I think this is why the efficient market hypothesis and the pharmas and all of the Chicago University stuff has come about, because in the market, trading is a zero-sum game. Somebody wins and somebody loses, right? That's not how business has to work, though. That's how the stock market works. That's not how business has to work. Business can cooperate. They can do things, not necessarily, I'm talking anti-trade, I'm talking about within their own ecosystem, within their own peer group, within their own company, to make the pie bigger for everyone. Stakeholders can do better overall. It doesn't have to be zero sum. A dollar in your employees' wages is not necessarily a dollar out of your profitability.
Well, the big challenge for organizations is that first of all, they don't learn about this in school. It's not Michael Porter. Very few people have ever heard of him. There's also R. Edward Freeman from University of Virginia, strategic, really one of the people who gave birth to this whole concept back in 1984 with his book. I think the real issue is that a lot of companies try to go about this in an ad hoc way. You can't. It's just you've given the evidence. Your portfolios work by looking at the big picture, not just the people picture, but are they in the right markets? Are they positioned properly? Are all of those other, it's not ESG, if you want to call it that, or stakeholder indices are not necessarily going to get you there. But what we know is not going to get you there is just paying people more money or just doing this on an ad hoc way or just doing that. No, it's stepping back. What is the system that you're building, right, and the foundation? And then you can work it out. No, folks, don't just go out and pay your employees $2 more an hour and figure that's it. No, look at the whole system. How can you get them engaged in innovation? How can you create gain sharing opportunities for them? How can you give them a piece of the action? How can you give them voice? Make it part of a system tied to metrics. That's the only way this works. So, and my only hope, folks, is that it's going to be people like you that change it. And here's how. The money is what really talks in the end. And I never even discussed stakeholder capitalism on the moral. Yeah, it is better for the world and society, but no, you'll make more money, folks. You will actually make more money and you'll sleep better at night. Won't be perfect. There could still be an earthquake. So that's my hope, that the free market will, at the end of the day, ironically, be the impetus and the good work that you guys are doing in terms of demonstrating, and of course, your Rational Capital, you know those guys, others like you who are doing your best to show the alpha of people. But also, it's not a get-rich-quick scheme either. Anyway, thank you so much, Brian Potts and Jason Britton, for your contribution to the show and to your contribution to this movement. And the show will be available shortly on our YouTube channel, and we'll write it up in a feature article that we'll be sharing for the next year. Thanks again.
Thanks, Bruce.
Thank you.